Welcome back to Market on Close. It's time for value or trap. And what are we to do? Because there have been some big moves to the up and the downside. I want to welcome in our guest to help us assess a few of these companies today. Scott Freeze, a portfolio manager of the AdvisorShares New Tech Media ETF, ticker FNG. A great guest here on a day in which the FANG stocks are on the move. Let's talk about one company in particular, though, Scott, that has been a pretty wild ride here this week. Roku. What did you make of those earnings?
You know, I actually liked the earnings. 6 cents versus an estimate of -10. I think the whisper was -6. The revenue beat by, I think it was 188 versus 183. It was a really good earnings period. It was not as strong as last earnings, but still very strong, moving in the right direction. The big issue was their guidance for their first quarter, with their revenue being $1 million or $2 million less than what the street expected. Now, does that warrant a 20% sell-off when the miss is really from higher cost of getting those NAND chips over because they have to fly them instead of using the cheaper route through the ocean? I think it's go ahead.
Yeah, no, I was just going to say, Scott, I'm glad you brought that up. I think it's interesting because they did say pretty explicitly, we're forced to spend more money on that air shipping to get those NAND memory chips, a shortage basically, that then cost them more money, and that then caused a pretty strong dent. Do we need to take, I mean, look, I don't want to cast doubt on what the company tells us, but that focus did seem to be very much on the outlook.
Yeah, and it's warranted. Anytime that you have increased expenses, it's going to be warranted. It's going to hit the bottom line, especially when revenue numbers are in the hundreds of millions of dollars and not the billions of dollars. Mm-hmm. So obviously, it's going to be a bigger impact. But is it a short-term or a long-term problem for the company that's really going to impact the stock? If you think of it as a short-term impact or something that maybe longer-term that they can find a solution to, then buying a stock that is 40% shorted already on a 20% dip, which ironically was only the last week's gains going back.
Right.
It seems like quite the value play down here.
2 points there that I think are very good, Scott. Guys, let's take a longer term look at Roku. Let's bring up the chart for about as long as it'll go, okay? Let's take it back about 6-7 months. And Scott, this week's chart looks way different, right? Because of the massive rally that we had. Now, the stock is relatively new here in the market, but we're now pretty much flat to where the massive bump was back in November. But Scott, to your point, there's a lot of confusion here on the street. I'm seeing analysts who have maintained price ratings of underperform or neutral, but they're hiking the actual target price while keeping the rating the same. I mean, it seems like there's a lot of clarity that's missing, Scott, to put it one way.
Yeah, I mean, it's just crazy. If you think that things are bad and it should be sold or it's an underweight, then why would you raise your price target?
Right.
We had the big arguments before of analysts raising their price targets just because the price was moving up so far so fast, and they wanted to be with it as opposed to fundamental valuations. So that plays some sort of factor into it. But the lockup on March 27th, I think, creates a lot less volatility around the name on a day-to-day basis.
Okay.
A short interest of as high as it is right now, if they fix any of their problems, then you're set up for a perfect squeeze.
All right, but Scott, let's talk then about that long-term picture, though, because did give that guidance lower. And the question then is whether or not their emphasis, I don't want to call it a pivot, but an emphasis to make money through advertising on the software platform that they offer, as opposed to the dongles and the hard tech, which is still very much a part of it. The more they get integrated into systems already like TVs, are they going to be able to continue growth and justify valuation with a advertising heavy revenue stream?
Yeah, and I think that they're going to be able to grow, and they're looking at 75% coming from advertising as opposed to the low 60s right now. Yeah. They did cut pricing on the top end from 130 to 100. They did offer a lower end service at $30. They're just not relying on hardware as much as they are advertising, but they also have these deals in with the Amazons, the Googles of the world that do see recurring revenue to them. So for them, part of this is the more TVs that they can be into, the more products that they can put out there, the greater the revenue stream is going to be, because they're not a direct competitor like a Netflix would be to an Amazon, where they're paying for original content and other things that are just going to add to expenses.
So you think that the idea of acting as an aggregator of sorts for this streaming content should provide a moat around them, Scott?
Yeah, I do. I think that they're fairly well insulated. I don't think anybody really expected after the IPO that they were going to shoot up as much as they have.
Yeah.
But they came out with amazing earnings, 2 quarters in a row that really shocked most of the people from a top and bottom line level. I really just think this little hiccup on Q1 revenue, and we're talking about $1 million to $2 million, not a substantial amount of money, just really oversold this stock.
Hey, and I will say that even though the guidance was worse, it was already expecting a loss for the year, right? They extended it to closer to 55, 60, but it was already in that 35 to 45 range. So this is nothing like a profit to a loss, right? The overall narrative hasn't changed much. But let's switch gears because Scott, I want to talk about Intuitive Surgical because the move in this company has been incredible. Can they keep it up?
Yeah, and that's kind of the issue. They're up 70% for the last rolling 52 weeks.
Yep.
They are definitely the leader in the space. Their Da Vinci products, they're expensive, yes, but they do have recurring revenue from it. Every time they do a surgery, they have to replace the razor blades and some of the pieces that they use during the surgery. So they do have continued revenue stream. I kind of get a kick out of the fact that it's always a concern. Medtronic is going to come out to be their big competitor.
Yeah.
Now they've delayed. A year ago it was TRCX, which is $1.60 stock now. J&J and Google were going to get together and knock them off the throne. They're the leader in the space. Nobody's knocking them off the throne. They're going to continue to grow, but that being said, they've moved so much so fast that even if they meet their multiples this year, I think it's 9.75 or something for the year, that only takes them up to $475 a share. That's only a 10% gain from here.
Yeah.
So from a growth perspective, I think we're kind of tapped out on how far they can go, even being the dominant player in the space and not having the competitors come in. It's just they've gone so far so fast that it is kind of a limited market that they're not going to be selling 20,000 units a week.
Yeah, it's we talk about the competition that you mentioned, Scott. I think that's a very fascinating point. And to wrap things up for us here, because the healthcare and the services and devices space has been pretty much a newsmaker every day throughout 2018 so far, given the amount of M&A, given the amount of competition that's heated up. I mean, are then tax cuts for some of these domestic companies going to add fuel to that fire if they've got more cash on hand, if they've got an easier bottom line to get to?
To an extent. I don't think that it's going to impact this space as much as like the financials or some of the techs or the repatriating the assets, because it still is a product-driven market. There are a finite number of demands for the product. You don't come out with a new product that all of a sudden means that low invasive surgeries triple. It's still a finite marketplace, and they're already at such a high point that even being the king of the throne and hard to knock off, the growth is going to come at a much steeper price, and it's going to be a lot harder to see the same kind of growth that we have seen.
Maybe then this is the reverse, then a company that has to diversify by finding someone else to potentially expand the business line, product line, apart from the Da Vinci. But hey, Scott, we got to leave it there. We're going to talk some more maybe about that next time. Have a great weekend, sir. Thank you for joining Market on Close. Good to have you back. Scott Freeze, the portfolio manager of the AdvisorShares New Tech Media ETF.